So apparently, if you're a guy like me that puts out videos on the housing market and the housing bubble, the impending housing crash, we're now classified as forbearance crash bros. All right, that's I guess the new label we've been given. And if you're watching this video and you're buying into the stuff that we're spewing, apparently, the advice to you is to try and not to create problems for yourselves by buying into boy band folklore and fairy tales. Hmm. If I was in a boy band back in the day, like, I don't know, 30 years ago, um, which boy band should I be in? NSYNC, Backstreet Boys, maybe the newer bands, One Direction. I don't know. Even my daughter wasn't into the boy bands. I think my wife kind of was, though. But the point is, I think this is kind of funny, and this goes to show that we're going to talk today about the housing narrative, and we're going to quantify the future or the next housing crash and crisis. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, as the housing market turns. It's another episode once again. Things like this just make me laugh. I'm Randy Patrick, your host, putting the realism back in real estate. Hey, if you're not already a subscriber, if you could help my channel grow and smash the subscribe button, I would really appreciate that. Let's get into it right now. Word of warning, got some charts, got some graphs, got some stuff I'm going to talk about. Will this be a longer video? Yes, it is. That's kind of my scene, making longer videos. So, and you know what? Don't just bail on me 10 minutes through. Watch this through the entirety so you can see where it goes. It's going to make sense. It's going to raise some interesting questions. So let's get it on, all right? So I look at this going mainstream media. It's a narrative is hard to understand, and the reason being because we see a lot of conflicted information. We know that certain groups, organizations, companies, whatever it may be, are pushing the fact that everything is great, where others are kind of going, maybe not so much these days, or we got to at least be aware of what's going on. So it really is confusing, and I can actually, I guess you could say, commiserate with a lot of people out there saying, what do I do with buying a house or selling a house or whatever? It's tough to figure out what is going on. All right, so let's get into it a little deeper now. So basically, my thought process for today is we are actually going to do math in public because right now I don't think the math doesn't really add up. Okay, and I'll talk to you about that in a second. Now, I realize that we're trying to extrapolate and make and figure out the future based on the information we have. And there's certainly some holes or some lack in some of the information. We're gonna do the best we can. I've been trying to figure this out. I figured, you know what, let's just give it a shot and see where we're at this point in time right now. All right, fun. So, and what's the whole idea? Well, it really is to debunk the housing narrative. Are we going down this continued bubble path, or are we going to hit a housing crash, correction, or maybe a rebalancing of values across the board? We will find out in the next little while. So for me, it boils down to very straightforward. Is we're going to get to the estimated numbers. Please follow along. Let me take you down the path. That's what I'm asking you guys to do. So just hang in there. So basically this stuff came out. Oh Lord, about a week ago, and this next little segment here will demonstrate just how fast opinions can change, perspectives can change based on who is producing articles and writing them, where they appear, what's going on. And it can change week to week. So right away, we've got here mortgage delinquencies expected to remain above pre-pandemic levels until 2021. So basically, things aren't getting better. Oh, guess what? Delinquencies could remain above pre-pandemic levels until March 2022. So things aren't going to get any better. That's sort of the message you're seeing here. Oh, delinquencies could remain elevated for years. All right, that's the message we're seeing as of last week. All right. Now, and guess what? Forbearance activity rises for the first time in 6 weeks. And again, this was in October 2nd, so this is 10 days ago, okay? So, and obviously what happens here is that we see forbearance volumes get calculated on a week-to-week basis based on information typically produced by Black Knight Financial, which is what we're all kind of looking at right now. So as of the end of September, first part of October, we had 3.6 million, we'll call it units in forbearance, according to their mortgage monitor, McDash, whatever you want to call it. So, and just going through this very quickly here, the divergence of early stage delinquencies and seriously delinquent loans has compounded in August with improvements in the former and a worsening of the latter. So what we're seeing here is we get monthly reports of like the mortgage monitor from Black Knight, yet we get these little weekly snippets of information from them as well too on the forbearance. So it's almost like we got close to real time, and then we circle back at the end of the month to see what's going on. So the most recent available end of the month stuff is August. Obviously, we'll get September's probably next week sometime. But the point I want to make here is the fact that apparently we're seeing less ongoing or new delinquencies, but we're seeing increase in serious delinquencies, which means less people are jumping into forbearance, but more people are going deeper and deeper with actually re-upping forbearance, being more seriously delinquent with their loans, etc. All right, so I'm just going to go through these stats really quickly here. So obviously, forbearance plans, extensions, and removals. So what has happened and why this was the end of September and first part of October is a critical time with the forbearance statistics. And the reason being because if you think about it, if you jumped into forbearance in April, you got April, May, June, July, August, and September. So you know what? So as this end of September rolls through, your initial 6-month forbearance period is actually expiring, all right? And that's end of September or early October. So if we're looking at some of this information, we have to be aware that we're kind of in a transition time right now. So this chart, which is a blow up of what was there before, just shows your scheduled forbearance expiration. So if you take a look at the middle of the chart, you can see that September and October we have a certain amount of change over there. But so we're going to see people leaving forbearance because their plans are over. So I guess the key is, are their plans over and can they continue and making their mortgage payments and they're back to normal, or are they going to re-enter forbearance because they're still in financial difficulty? So this is kind of critical. This is the first sort of major wave happening right now. So get ready here. Negative equity, distribution of loans, and forbearance. So just going down this chart here, obviously we still have a good number of properties in negative equity, number of underwater mortgages. All right, so we're talking probably almost 1 million homes that are underwater with respect to their mortgages. Now I'm going to say something. This is Black Knight Financial. I have looked at a number of different statistics over the course of since the last housing crisis looking at this. Black Knight are newer on the scene the past few years, so I've looked at the CoreLogic stats, Atom Data Solutions. I'm going to tell you that Black Knight tends to be the group that either is the more conservative or underreports. And again, there's no. Do I have any quantitative, information on that? No, just it's comparison. I usually see Black Knight lowest, CoreLogic next, and Atom Data Solutions tends to be, I think, more realistic. They tend to have the higher numbers. Not that I'm gravitating towards that, of course, but just when I look historically what's been going on, who's been calculating it, Atom Data Solutions has always been the forefront. So again, just take that with a grain of salt. But the point is, we've got 1 million, negative equity underwater mortgages that are going on right now. All right, distribution by loans and active forbearance. So, where that red arrow is, it just shows that, that segment, which is FHA, VA, has the most, I can say, the most loans in forbearance that have, we'll call it worse loan to value. So, each of these little 4 market segments, GSEs, FHA, VA, portfolio, and then again, the all-in loans and forbearance. So the first 3 segments there, distribution of loans, you can see that the light blue, the most left of the 4 or 5 pieces to each little segment there, clearly less people, how can I put it? More people in FHA, VA have less loan to value, have less down payment. So they have greater loan to value numbers. So for example, you've got there's 16% are in the 90 to 99 percentile loan to value. 17% are 80 to 89, 19% are 70 to 79, and only 47% are less than 70% loan to value. So the point is, in this case, that the equity trend is showing that FHA mortgages tend to be a little more risk oriented here because of higher loan to value. And actually, we've even got a few, greater than 100%. All right, so their combined loan to value is actually, they can't sell without bringing money to the table here. So it's a difficult scene, but just going to show you that how these equity trends kind of move through. We'll get into this a little deeper now. This is kind of their, when we're going to focus on this on these slides quite a bit. This is the mortgage monitor showing the fact that how many forbearance plans we had over time and where the breakdowns are. So if we go to this a little bit more, basically about 6.1 million homeowners slash homes or mortgages entered into COVID-19 forbearance. And as of, the most recent information, well, in this case, we're talking as of end of August, you got about 3.6, 3.7 million homeowners, mortgages, homes, properties are in active forbearance plans. All right, if you see the breakdown, this is very interesting here. So, and again, this is where we've got some blending of statistics. So we're blending some numbers, end of August numbers, yet we're looking at the current status that's showing September 22nd. Okay, so we're looking at a little bit of a blend statistically here. But the point being, take a look at this pie chart. On the left, on the bluey, the lighter blue, 46% of the 6.1 million people that have been in the forbearance program had their term extended. So what that means is that they couldn't come out of it, they couldn't perform, they needed more time. 46%. Go to the big green piece. 30% were removed from forbearance and are performing. The next, the yellowish, or gold, 4% removed, expired, delinquent, and what that means though is, so they're not engaging forbearance, but they're what's called active loss mitigation. So the lender's trying to do some workout program with them to get them back on track. Now, will all these 4% go into a loss mitigation program? Not necessarily. A lot of loss mitigation falls out at a very high fallout rate. Okay, so that 4%, could turn delinquent. The pure delinquency out of this group is only 1%, which I just tend to not believe that. I think it's such a low number. Removed, expired, delinquent, and that means 1% left the forbearance program and have done nothing about it, and they're now truly delinquent. 6% were able to pay off their loan. That could either be with refinancing or by selling the property. And you've got 13% of the 6.1 million people who are still in their original term. So that maybe they entered in June or July or even August. So they're still new in their term. Their term hasn't expired yet. So that breaks down your 100%. So we're going to refer to this chart quite a bit as time goes on. All right. So here we go. Just so you know, the mortgage monitor loan count and average day delinquents at the very, very bottom, end of August, we've got roughly 53,500,000 loans that these guys are saying are out there, and about 3.866 million are non-current. That's the numbers they're looking at. All right. So the numbers are not adding up. And for me, I've been struggling with this for quite some time. And as I mentioned earlier, that, okay, maybe there's some underreporting going on. Maybe there's some conservatism with respect to what they're showing or what they're producing. Because quite frankly, we don't know who they're asking, how they're asking, what they're asking, how they're looking at their statistics, and what their methods are, what their calculations are. So we have no idea. They're producing based on what they've done. So I don't think the numbers are adding up for a couple of reasons. And again, when we take a look at this, and I'll put the link to this in the information section of the video, okay? The data summary, we've got new originations, when you look at this, the new originations tend to be going up as the month goes on. The delinquencies look like they're holding, they've gone up, they've dropped a little bit, and they're kind of holding for a bit. So, there's confusion out there. If you bring this chart up, you can take a look at foreclosure, fines, whatever. Realize that, as people enter into forbearance, they are delinquent, and there is, people who don't pay their mortgage after 30 days, they become delinquent. When you hit about 90 days and go greater than 90 days delinquent, you now become seriously delinquent. And at some point in time, you'll become a foreclosure statistic. You will have a notice of default, or what's called lis pendens, which is notice of litigation or lawsuit in Latin, filed against you, and you'll now become a foreclosure pay count statistic. Now, we see that the foreclosure pay counts are actually dropping, and the reason being because foreclosures aren't being filed. Because why file a foreclosure if we can't take them down the path to foreclosure, sale, and eviction, do the moratorium? So we're seeing unusually low foreclosure statistics because of those reasons. They can't foreclose on most of them. They can't evict the homeowners who are already in the foreclosure process that have been foreclosed on. So why go through the courts and keep cranking up stuff that's just going to backlog and move nowhere? So again, in the future, once the eviction moratoriums and things open up a bit, we're going to see a slew of these, a massive amount of these get refiled. All right. And just a quick look here, the state-by-state rankings by non-current loan population. If you take a look at it, this is the three columns represent the 50 states, and you have state delinquency, FC, which I'm sure is foreclosure, and NC is non-current. So you can see states like Mississippi, non-current, Louisiana, Hawaii, Nevada, Florida, Connecticut, Texas, New Jersey, Maryland. I had it was New York, not Nevada. Then Nevada down here, Georgia. Looks like Alaska possibly in that, Alabama, West Virginia, Oklahoma. So what I'm seeing now is as the months have gone on, and again, realize I'm not from here, so if I mess up the AK abbreviation, whether it's Arkansas or Alaska, I don't know. I'll look up afterwards, okay? Well, I'm pretty good at naming all the states, by the way, capitals. So, but the point is, the fact that now we're seeing the typical states that had issues during the last housing crisis are now rising to the top with the non-current. And we're taking a look at the national non-current, over 7%. You got some states that are over, are into almost at, double digits or entering close to double digits now, which is huge. And when you take a look at the year-over-year change in non-current, you can see that some of these states like Nevada, year-over-year change, 200%. You got Florida, 119%. Go to the far right columns. Look at, your California, 170%, Minnesota, 100%, North Dakota, 135%. So the states that were traditionally not a lot of foreclosure funds or non-currents are growing and gaining, and those statistics are like they're becoming, you're changing by 100% or 50% or 75%. That's significant amounts, for a year-over-year change. So again, the world is changing whether we like it or not. Now, how I'm going to get into this now is that it's all about timing and how it's reported. This is what I sort of figured out this week going, okay, just last week it was, oh my goodness, we're going to see, delinquencies and problems going on into 2022, right? And that's produced, and then we see some different information come out this week. And again, we're going to go back to this chart as some basis points here. So, coronavirus mortgage bailouts fall below 3 million for the first time since April. What? What about that? Well, that came out on Friday. So it looks like we just got some publications that came out that amended some numbers. All right, well, what about that? Well, look, forbearance has seen largest single decline yet. Oh, Lord, after a slight uptick the previous week, we saw it fall and plummet, not just fall, but plummet over the past 7 days, falling by 649,000 from the week prior, an 18% reduction in the number of active forbearances. Okay, my goodness. So, well, that's humongous. That's beautiful. The markets, prices are up, inventory is low. People are buying, mortgage rates are low. Now people are jumping out of these forbearances. It only can mean good things for the housing market, right? Well, let's hold our horses here because this is not a correct number, all right? So we've gone from 3.6 million, whatever that number was, the previous week to what, 2.97 million right now. Okay, I think it's too soon to report or wave flags. And the reason why I say that, because it's the people who are going in and out of forbearance. As I mentioned earlier, if you're in a forbearance program that's expiring end of September and or the first week of October, if you technically expire, then guess what? They've now pay counted you as being not in forbearance, not active. So that loan and forbearance number drops dramatically. But just because you finished your initial forbearance program, it doesn't mean that you're automatically put in the next forbearance program, the next day. So if on September 30th that you expire and October 1st you haven't called in to get on the next forbearance plan, well, guess what? You're not counted, all right? Even though you may want to, or maybe you did, or you're going to, etc. You see, so I think that's why we have to look at this with a grain of salt. And I certainly believe that, if we take again, this is that sort of timing issue right now. We're right in between, a time period where there's a lot of people who are ending their forbearance and have to make a decision. So that, to me, that's why, take this with a grain of salt, folks, all right? So this is why I think it's a quick, that's why I say wait. I think this is being reported and talked about, because it's good news, and we're so, the housing narrative is so desperate for good news. And I get it. Listen, I do get it out there, and I'm not one just to poo-poo everything, right? But the point is, we're so desperate for good news that we're running with an article, and this is exactly the reason why. This article, which I'm not even going to credit who writes it at this point in time. Maybe he's watching, maybe I'm part of the forbearance bureaus, but the point is, waving a flag on this reduction based on the timing of where things at, I think is a little too soon. Maybe at the end of the month or early next month, if we're still down, then I'm wrong and you're right. And that's and maybe things are getting better, or the economy's changing. People are getting their jobs back, whatever. But I just find it hard to believe that we're seeing such a big swing in this specific time period, and that's why I don't buy the information. All right. So, oh wait, and I actually want to point something out here too. So please, my other second, so you see my red circle with the 2.9699, 2.7, but the little red arrow says, get this, figures in this report are based on observation from Black Knight's McDash-Flass data set and are extrapolated to estimate the full mortgage market. Okay, so you know what? I just read that and I noticed that this past week. So this is basically methodology. We don't know the methodology of how they're calculating this information. That's why I feel much better about these numbers. And what I mean by that is I know that the numbers are underestimated or underreported or conservative because of that that discussion point right there, that asterisk, the first asterisk. So it's based on observations. We don't know how or what they're observing. And again, don't get me wrong, this is a data company. I'm sure they're pretty solid on stuff, but I think that we don't know how the information is being calculated or manipulated or looked at. And just again, my historic comparative speaking, when I read this information over the years, that I just believe that this is not a they're going to lowball the number as opposed to highball. And you know what? That's part of the narrative. What do we with respect to narratives? What do we not want to do? We don't want to instill fear. We don't want to instill panic. We don't want to freak people out. Okay, cause mass hysteria, riots, whatever. Listen, we've already had some of that going on. So with the economy, the country, everybody here doesn't need more of that. But so there's the downplay. But I think for me, putting the truth in real estate or putting realism back in real estate, I think we need to know this information. And it's, to me, it's somewhat confusing. So let's say, wait, more information here. Guess what happened mid-September, okay? Realtor.com. So of all the groups to actually come out and talk about this was a surprise, all right? Realtor magazine says 1 million delinquent homeowners haven't asked for forbearance. So what they mean is that there's 1 million mortgages / homeowners out there, and they're not under the forbearance plan. So the Black Knight statistical numbers, whether it's 2.9 million or 3.6 million or something in between, which is probably more of what it's really going to boil out to be or hash out to be, that there's 1 million that aren't under forbearance. So we've got 1 million that aren't being calculated right now. So what does that mean? Why, that's where I kind of numbers don't add up, because if I take you to one of the slides, it showed 53.5 million mortgages across the U.S. estimated and 3.8 million or so forbearances. Well, that's what they're looking at, but we got 1 million here that's not in forbearance. So we're missing 1 million delinquent loans. And if they're not in forbearance, that means they're exposed, which means they're sitting there doing nothing but wallowing and going through a foreclosure auction process, a soon-to-be auction process, a resetting auction process, the foreclosure process, or an upcoming notice of default setup. Okay, so it's 1 million homes that are exposed, not covered by forbearance, that are not being added into the numbers that the Black Knight group is actually talking about here. So this is more than and again, this is non-forbearance. So these are legit delinquencies that are not covered by a forbearance plan. All right, and to sort of make matters worse, going back to Housing Wire here, is that out of that group, they believe that there's about 400,000 mortgages that I guess you could say are covered by the forbearance plan. So they fall into mortgages with whether the GSEs or FHA, VA, whatever, that could jump into the forbearance protection, but they haven't. Are there reasons why they haven't? Yeah, because of confusion, because lack of communication, because of fear, just because of not knowing what to do or putting your head in the sand. A lot of that going on, I'm sure, with respect to all the other, crisis, pandemic, financial issues that people are facing here. So again, this a million plus people, in delinquency status, future foreclosures. 400,000 of those could jump into forbearance plans right now if they were aware. So to me, that's very interesting. When I look at this, okay, this is the FHA chart that I like to refer to, created by the American Enterprise Institute. This is through the end of August, so it kind of sort of tags up with the August mortgage monitor from Black Knight. And again, this is at the top 10 most threatened markets. So you've got basically an active portfolio of almost 8 million FHA loans, and you've got 17.4% of those loans are delinquent, 11.2% are seriously delinquent. So that's why when I look at the delinquencies, and again, could a lot of FHA be in forbearance? Yeah, but when I'm looking at some of the numbers and how I extrapolate these numbers as well too, that I don't think it makes sense as well. Like you got 1.3 million delinquent loans, and if FHA is or maybe 10 or 11% of their loans are in forbearance, like I don't know. Sometimes the numbers, again, they just don't seem to add up when I look at everything, completely. Put it on chart, put it on a board, whatever. So realize that this is somebody else's statistics, American Enterprise Institute, and there you go. So and that's coming from FHA Neighborhood Watch data. So they're actually going to the source to get the information. So again, things change, right? But the point is, I again, underreported, numbers not adding up, the whole bit. So I think there's more to this, and for whatever reason, well, we know the reasons why it's being downplayed at this current point in time. So time for math. Now, math in public, I think I've referred to this before, why I call it math in public and why I joke about it a little bit. Enron, if you remember the Enron scandal back in the 90s, there was the chief financial officer, which is I think Jeffrey Skillings, and he was in front of Congress or some Senate committee, and they were asking him about this, and they were throwing out all sorts of information, and he basically said he couldn't comment on or answer the questions because I don't do math in public, was his quote. So that's what I like to always say here. I'm doing math in public, so let's just take this with a grain of salt. And I'm just trying to make some sort of estimate numbers to sort of quantify where this housing market's going to go and how many distressed properties there's going to be available out there. That we can look at it and possibly acquire. Possibly you could buy to let your primary residence, invest, whatever you want to do. Where the market can go based on this. So again, realize that we have 1 million plus delinquencies as per Realtor Magazine, not in forbearance. That's a given. Okay, we're going to work with that here. So now I'm going to go back to this. So look at the active forbearance, all right, and the term extended. So 46% of the people who are in the forbearance world of 6.1 million, 46% had to extend their term, which means they're having financial issues, income issues, and cannot pay their mortgage. It's 46%. Let's go back to the top. 30% performing, 4% into loss mitigation programs, 1% are delinquent, 6% paid off, and 13%, because of where we are today, are still in active forbearance situation. All right, so I'm going to make some assumptions here, guys. So we know that 46% extended forbearance. Let's apply the same ratio to the current active forbearance that had to extend. So if I take 46% of 824, I'm going to get about 3.8 mil. Okay, so let's talk about we're around 3.8 not 3.8 million, 380,000, 380,000. So almost 400,000 people are going to, if those ratios are correct, when their forbearance plans are up, they're going to extend. All right, which equals about 3.2 million people in the extended forbearance bucket. Okay, let's agree upon that. Equals approximately 3.2 million people extended forbearance bucket. Let's assume a 50% default rate. And what I mean by that is, um, so out of those people in forbearance, that these are the ones that have to extend, that they're having financial issues. They can't cure it, they have to extend it, which means, and we know this from other statistics over the years, the longer somebody goes into delinquency and the deeper they go, the more severe delinquency they are, the exponentially rises the less chance of them to cure that, and to go back on a mortgage plan and to get current the whole bit, do a loan mod, workout, whatever. So I'm going to take, and this is again math in public, I'm going to say out of that group, let's assume that 50% are going to hit the default rate. All right, and that equals 1.6 million potential future foreclosure filings. So I'm taking the extended foreclosures. All right, I'm taking the current and saying some of those at the same ratio will be extended, and that gets me my 3.2 million. I'm going to say let's assume at least half of those default rate equals, are going to go into default, which is, hey, now we're going to have a foreclosure filing. That's 1.6 million people out of the 6 million in forbearance. All right, which quite frankly is not unrealistic here, guys. All right. Now, if I go further with that, okay, 1.6 million filings plus the 1 million that we know is not even counted in forbearance, I got about 2.6 million future foreclosure filings that are going to happen 2020, 2021, 2022. All right. Now, out of that 2.6 million, let's just net it out to nicely to 2 million foreclosure filings. And why do I say that? Because some people will do loan mods and they'll have some workout programs. The farther they're down, the more difficult it is. So that's how I look at it. So I'll just say let's just round to 2 million. Again, math in public, making some assumptions here, but I don't think my assumptions are that far off. All right. If you saw what happened in the last housing crisis and what went on, we had way more. So I think, and the narrative pushback is that this is not like the last housing crisis. Well, again, the last housing crisis, was over a 5 to 6 year period. We've really are in a 6-month period right now trying to figure this stuff out. So, we're talking, 60, 72 months versus 6 months. So, 6, 7 times, 5 or 6 times, the time frame as to where we are now. So we got to make some assumptions. Initial jobless claims are not decreasing. They were at 840, 50 and change the past few weeks. So we were topping almost 64 million initial jobless claims. And we know that in some states, they don't even have their jobless claims website open because they're trying to catch up, which further perpetuates the situation. So, this is unprecedented numbers that still will have to work its way out. We have the whole mom and pop landlord rental issues, Airbnbs that aren't even on the fringe of this as of yet. Next year, we're going to start seeing that stuff sort of fall apart. So, when I look at numbers, this can get pretty big pretty quick. All right. Now, what do we got here? Let me move this over to the next slide here. Now, if I extrapolate their numbers, let's go back to their slide. Okay. Look at what's performing 30%. Okay. So out of 6.1 million, only 30% are performing, right? Other part of extended, right? Removed delinquent, 4%. Active loss missed. The non-active loss mitigation, 1%. Paid off, 6%. Active in forbearance, 13%. Let's go to the next little calculation here. So if I use their numbers, if I have performing 30%, paid off 6%, active loss mit 4%. So total not in forbearance are about 40%. All right, we got that 10, 13% still active. So I'm looking at, okay, well, if 40 to 50% aren't performing, you know what I mean, and maybe again, as time goes on, it's not getting better, it's getting worse, right? So if I were to take, just based on their numbers, if I say 45 to 50% of those loans in the forbearance are not performing, that's going to give me between 2.7 to 3.02 million. So I'm not far off on looking at this if I'm going by their numbers on what's performed, what's sold, what's gone to loss mint, the whole bit. I'm taking what they're giving me here, guys. That's the numbers. I'm not creating this. I mean, yeah, I'm doing some. Listen, we're all making estimates and guesstimates here, but when you look at this is not. I'm not off the mark here. All right. So 40 to 50% would equal that much. Adding our 1 million on top of that, so we're still going to be over 3 million to 4 million, somewhere in that range. Okay, that's what we get. So the point is a lot, and unless and why do I say that? So think about that. Almost 3 million, adding a million on, so we're almost 4 million, right? That's where we could get on this here. So my point being here that 6.1 million homeowners will not magically be able to either cure their loans or sell their property. There will be casualties. This is very, very basic math, but however, you can see where this could end up. And what I mean by that is, okay, cure your loan is you're going to go current. The lenders are going to work with you. You're going to modify your loan. They're going to mess with the payments, distribute your loss accrues over the course of the loan and put it at the back. But the point is, you have to have income for that to continue. Unemployment income is not income, all right, according to the lenders when you're doing loss mitigation workouts, okay? There will be casualties, all right? 6.1 million people aren't selling their home, okay, aren't paying off. So you think about it going, let's, and the thought process is, let's take all this newfound equity and pay off our home. Well, if only 6% have paid off their home, either with a refi or, and again, refis are not as easy, having, the forbearance on it, that can cause some potential problems, or just pure selling of your home, where you're going to go, you see? So this is, I think, just a larger problem that has Band-Aid solutions that we're working on housing narratives here because of the timing of where we're at and what's going to happen in the near future, all right? So, and that's why, for me, when people are talking about the fact that, hey, your forbearance crash, bros, you're out of gas now. This doesn't make sense because look what just happened to forbearance. To me, that's jumping the gun, or what they call jumping the shark, right? That you're not quantifying the true numbers in this here. And that's how I look at it. So again, I'm not a math major. I'm just looking at numbers and stats, trying to make heads or tails of this. But I don't think what I've said is, I guess you could say, out of the realm of possibilities. Put it this way: we got a million right now, not doing anything or not coverage, right? Uncovered. Pull out the Black Knight numbers and start looking at what's really happening. 40 to 50% are sort of out of the forbearance bucket, and whether they're performing or not, or just they've exited for various reasons, you got 50% still there that are going to have problems. So take the 50% still there and start doing some ratios on that to see what you're going to get. You're still going to get over 2 million that are going to have problems over the next course of 1 or 2 years. Now, if 2 million homes are having problems, is that going to help housing prices? Well, when we have a seasonally adjusted rate of 5 to 5.5 million sales, you add 500,000 distressed properties on there, that could certainly bring down some prices. That could alleviate some inventory issues. But the key is, will those numbers and will those homes eventually get to where it's impactful for us to either buy it, or whether we can see some of the price declines that will hit? Well, I don't know at this point in time. Why? Because there will be headwinds. And listen, this is the fun part. So I didn't even add this today because I figured, what are we at here? I'm at 38 minutes right now, guys. So I gotta close this off as soon as possible. But the point is, I just looked at some CoreLogic information that says, hey, they believe that based on what's going to happen over the course of the next few months with the COVID and the delinquencies, whatever, that they said 27 states are going to show a decline in housing values. So this is the confusion in the narrative here. So you got groups here saying that us forbearance, boy band guys are, and housing crisis people are a joke. Yet the numbers are there, okay, to show that there's going to be some problems. You've got CoreLogic, and if I always reference CoreLogic, what does CoreLogic also reference? S&P, CoreLogic, Case-Shiller, U.S. Home Price Index. So in that index, CoreLogic's name's in there, so there's some ownership and some control on that. All right. So if they're actually saying we see price declines in 27 states at this point in time due to COVID-related things, and what's a COVID-related thing? Forbearance and foreclosures and delinquencies. Well, to me, that's what does that mean, guys? That means that other people who are way smarter than me are seeing some of this as well too. So I can't be the only one that's talking about this. Again, it's quantifying the housing crash. So does this take us 30 to 50% down in housing values? Probably not, because again, there'll be headwinds. People are going to be fighting that, and there's going to be solutions for some of these homeowners that are delinquent. There will be solutions for them, but some of them will redefault. Some of them won't take the solutions. There will be carnage. There will be casualties. So we're going to see some movement here. It's just trying to quantify that. So I think, if we can quantify the number, like the number of foreclosures that are going to hit or participate in sort of the slide, that's a starting point. To quantify, the next step is to quantify the decline, which, CoreLogic saying 6%, 10%. Some markets are 1%, some markets are 20%. It's all over the board. And so for me, we're not probably going to see the 30% across the board decline in home values. We're going to see various metro markets having, some are going to see significant decline, some not so much, some in the middle. So it depends on where you live, where you're moving to, from where, with what money you cashed out with it. So that's why I'm saying it's a hard narrative to follow. There's conflicting narratives, but the point is we got to learn this, we got to figure this out to make the right decisions for your real estate purchases in the near future. So guys, thanks very much. I know it was a long video, but I just wanted to put this out there to sort of say, listen, I read this yesterday and I thought, you know what? I don't particularly like what was written. And I'm not even going to reference this in the information section, just that we're being referred to as, again, I don't go out and there's enough, again, pro-housing narrative out there that I just acknowledge it. That's your opinion. This is my opinion. I'm not trying to debunk anything. I'm just, again, putting the realism back in real estate so I can make decisions, my clients can make decisions, and hopefully you can make decisions as well too, not to spend so much money and buying at the top of the market with low interest rates, with high debt to income ratios and low down payment, putting yourself at risk and the market at risk. So anyway, guys, I talked about this before. With respect to the foreclosures that are going to happen, we've got great things going on with respect to how we're going to approach this market, what we're implementing. So you want to get ahead of these buyers. That's the headwinds. These people are going to be there trying to pick off the properties before we do. What I developed and partnered with people, I think it definitely is a game changer. So if you'd like information on how to get your hands on properties, need to find out, contact me for a consultation. I don't put this out there in the general media because I don't want to. And if you're already in the program, we're rolling this out. I'm going to have some teleconferences shortly. I've got some documents already. It's the best and cost-effective way to stop a foreclosure sale. Helping homeowners, helping ourselves buy cheaper property, and just transitioning out from bad situations to better situations. So that's the scoop, guys. Anyway, thank you very much. Appreciate the views, appreciate the likes, appreciate the comments. Yes, it's a long video, but I think it had to be stated as to where this could actually go. And again, you can always put it at 1.5 speed, and therefore two times speed. And my 40-minute video is a 20-minute video. All right. So again, reach out to me for more information on the training I've talked about. Reach out to me if you're looking to purchase property in my area. Reach out to me if you're looking to invest in property, because this will be a lot of what we'll be focusing on real estate investing. It's the off-market stuff, the stuff that's hard to get. That's where the key is. That's where the deals are. Okay, guys. Thanks very much. We'll be talking to you shortly. Take care.